There's an open secret in geopolitics right now. The BRICS countries have been accumulating gold like there is no tomorrow. And that's led to a spicy theory. Are they plotting some kind of comeback for the gold standard to get away from the US dollar? Gold's price has smashed through major milestones this year, and all the time, the dollar's status as the global reserve currency is coming under greater scrutiny. But what might BRICS be planning with their gold stores? How might it actually impact the markets? And how realistic is a new BRICS-led gold-loving regime? We dive into all of this and more in today's video. My name is Guy, and you're watching Coin Bureau Finance. First up though, I'm not a financial advisor and nothing in this video is financial advice. This is educational content meant to inform you about BRICS and its strategic shift with gold. And if you want to see more stuff like this, hit those like and subscribe buttons and flick that notification bell too so you don't miss the next video. Okay, let's start off with an overview of these gold flows. Central banks have been buying gold at a pace we haven't seen in decades. According to industry tallies, 2024 marked the third straight year of central banks purchasing over 1,000 tons of the precious metal. That is a powerful tailwind for price and a clear signal about how central bankers are viewing the world. Now for the BRICS angle. China's central bank paused its long buying streak in mid-2024, but then got back to it that November and carried on into 2025. The country now sits on just under 2,300 tons of gold, and when the world's second largest economy keeps adding gold aggressively, the market is forced to take notice. Russia has also signalled its love for bullion and is currently the group's biggest gold reserve holder with over 2,300 tons, and it's no wonder why. Gold's price soaring has helped ease Russia's woes of losing massive foreign reserves, which were frozen back in 2022 following the outbreak of the Russia-Ukraine war. When your foreign reserves get sanctioned but your bullion keeps climbing, the incentive to hold more bullion is pretty clear. India's central bank, meanwhile, crossed the $100 billion mark in gold holdings this autumn, mostly thanks to price appreciation on top of earlier buying. That's significant for a country that's long been a consumer heavyweight, but is now visibly adding gold to its official reserves. Again, it's not really a mystery why, it's just a case of a big economy spreading its risk. But why are so many central banks doing this at the same time? Well, you don't need us to tell you that the world and the global economy are undergoing a major shift. So, central banks are incentivized to diversify, avoid sanctions risk, and become less dependent on someone else's system. After those 2022 asset freezes, a lot of developing countries took the hint and started diversifying harder, with gold winning largely because there's no major counterparty risk if you store it yourself. Now, to what degree that is anti-dollar is up for debate, but it's undoubtedly a major shift in how these central banks have approached their risk management. Now, there are a couple of things to keep in mind when looking at these numbers. Reported buying can be patchy, and some central banks disclose with a lag. That's why you may see months with a pause followed by a big catch-up print. Also, some speculate that China in particular is underreporting its gold buying to accumulate in stealth mode. But either way, the underlying trend has been a massive surge up and to the right since 2022. And before we continue, since we're throwing around the term gold standard, here's a quick reminder on exactly what that is. A gold standard means your currency is fixed to a set amount of gold, and people can convert paper money into metal at that rate. That hard link limits how much money you can create and how you respond to crises. That is in contrast to today's fiat money, which just means it isn't convertible into gold and can be expanded or tightened as policy demands. That flexibility is the point, but it's also the trade-off. So, where does that leave the BRICS gold standard rumours? Well, there's no gold standard BRICS currency yet, but right now the gold accumulation is undeniable, consistent, heavy and strategic buying. And that confirms one thing if nothing else. Major economies around the world are actively moving further away from the US dollar. So, BRICS aren't likely to roll out a new collective gold standard currency. However, that doesn't mean the gold accumulation couldn't play a big practical role in a move to get out from under the US dollar. But how so? Well, for now, the real focus for BRICS is more practical, making it easier to trade without using dollars as the default middleman. That's what they're trying to do here: cut dollar dependency in trade and finance without nuking their own systems in the process. To complement this, however, the BRICS gold stores may still have a role to play. But in this context, you can think of gold less as money and more as neutral collateral and an anchor for settling imbalances. Now, Moscow itself has said there's no plan for a BRICS common currency. The focus is on building ways to settle trade more smoothly in each country's own money. So, we're not talking about a gold standard currency, but possibly a gold-anchored settlement option. BRICS banks could clear most flows in local currencies, then periodically net out residual balances with allocated bullion held in friendly vaults. That means titles move, but the metal doesn't, reducing counterparty and sanctions risk without pegging anyone's currency to gold. Brazil, which currently holds the BRICS presidency, has been equally clear. No common currency is on the agenda, but the goal is to lower reliance on the dollar in trade. In that framing, gold can sit in the background as super collateral, posted to a clearing hub and margined just like other high-quality collateral. That way, everything keeps moving even if foreign exchange lines seize up. So, what are the BRICS actually building? Well, first, we have the Cross-Border Interbank Payment System, or CIPS. This is China's bank-to-bank payment network for settling cross-border trades in yuan, and major global lenders such as HSBC have plugged in as direct offshore participants. So that's clearly not symbolism, but a way to move money in yuan with fewer detours. It won't replace the dollar overnight, but it gives exporters and importers more options, to put it in politically sensitive terms. A gold anchor could fit alongside this. Invoices in local money, netting through CIPS-linked banks, and gold posted only to settle periodic imbalances. Then there's mBridge, a shared experimental platform where central banks settle cross-border payments using digital versions of their currencies. This is like central banks testing a common highway that lets payments land instantly and cleanly without the usual bottlenecks. The project hit a minimum viable product stage in 2024, which means it's past the whiteboard and into controlled, real-value trials. If BRICS wanted, they could overlay tokenized, fully allocated gold claims as collateral on top of such rails without turning gold into the unit of account. And it's also important to note that it's not just the founding members of the BRICS bloc kicking the tires here. The Saudi central bank joined mBridge as a full participant, widening the network across key energy trade corridors. Every new participant makes it that bit easier to route trade settlements off the dollar track, especially for oil and commodities, where the dollar has been the default for decades. There are also ideas on the table for brand new settlement plumbing. At the 2024 Kazan summit, leaders discussed a BRICS Clear infrastructure, a cross-border settlement and depository system designed to keep trade moving even if Western infrastructure gets shut off. A dedicated precious metals exchange has also been rumoured, which would give BRICS their own benchmarks and standards for bullion used as collateral. Meanwhile, China's CIPS keeps growing, though it's still smaller than the old guard networks. But the plan is in place: build more routes, make them usable, and let time and volume do the rest. And if you're wondering why any of this matters, consider the typical pain points in the US-dominated system. When banks in China or Turkey get jumpy about sanctions risk, payments to Russia can get stuck for months. That's brutal if you're shipping oil or machinery and the cash isn't arriving. New rails and local currency settlement offer a fix for a very expensive business problem. Gold collateral adds another layer of insurance. It's outside money that isn't a claim on a Western bank. Vladimir Putin said last year that the existing BRICS infrastructure is enough for cross-border settlements right now. In other words, the pressure is to use what alternatives already exist while gradually adding new routes that are harder to block. It may sound simple or even a little boring, but that's exactly how systems change, slowly and incrementally, and then seemingly all at once. If more trade settles directly in yuan, rupees, rubles, or other currencies, the dollar isn't in every transaction by default. That chips away at the network effects that have kept the dollar at the center of global trade finance for decades. For BRICS, that lowers exposure to US financial rules and gives their firms more predictable access to funding and settlement. For markets, it means liquidity and pricing power slowly spread across more hubs. And if needed, gold can serve as a neutral anchor for all of this. None of this necessarily requires a hard gold standard or a single BRICS currency. It just needs enough credible infrastructure, enough banks using it, and enough trades priced and settled without using dollars. That is the main move here. Not necessarily a new reserve currency, but fewer reasons to use the old one. Needless to say, all of these developments have produced a lot of volatility, and there's more expected in the future. So, if you're looking to take advantage of that volatility, then check out the Coin Bureau deals page. Over there, we have numerous finance-related deals and bonuses exclusively sourced for the viewers of this channel. To check that out, scan the QR code over here or the link down in the description. They won't last forever, so take advantage of them ASAP. And now, back to the video. So, what does all of this mean for the markets? Is it time to ditch all your dollars and buy gold or Chinese yuan? Well, as BRICS countries move to acquire more gold and potentially work it into their international trade systems, the precious metal is likely to enjoy strong long-term support. But this doesn't necessarily mean the dollar dies. In fact, the dollar's grip on global finance is still very tight. It may sound confusing, but all of these can be true at the same time. So, let's go into a little more detail. On the gold side, the most price-insensitive buyers have been central banks. They racked up a record haul in 2024 and are on pace for another big year in 2025, which helps explain why gold keeps clocking fresh highs. That's steady demand from players who are certainly not the type to panic sell on a scary headline. The more BRICS countries lean into this shift, the more momentum it develops. And the shift is also now visible in reserve portfolios. With prices screaming higher, gold's slice of global reserves, mark to market, reached roughly a fifth of the total in 2024, overtaking the euro's share. That's a big optics win for bullion and a reminder that countries can move their safety nets even if their currencies don't move with them. But before we declare the dollar dead, it's time for a little reality check. The global currency market still revolves around the USD. The latest numbers from the Bank for International Settlements say the greenback sits on one side of about 89% of all FX trades, and daily turnover has ballooned to roughly $9.6 trillion. Network effects like that are not going to vanish anytime soon. Payments, meanwhile, tell a similar story. According to research from Swift, the renminbi is getting used more often. But in mid-2025, it was still only a small single-digit share of global payments by value. Progress? For sure. A change of the international order? Not yet, and by some margin. However, it's important to keep an eye on how this develops. When a bank like HSBC plugs directly into China's SIPs, it gives big companies a cleaner way to settle in yuan without bouncing through dollars. That doesn't dethrone Uncle Sam overnight, but it means the range of options is expanding. And then there are the new rails being tested by central banks themselves. Project mBridge has moved beyond the whiteboard phase, and that invites more participants to run real transactions. If those trials keep scaling, you get faster, cheaper settlement across borders in multiple currencies. So, what does this mean for markets? Well, regardless of how far the BRICS nations go with respect to working their gold stores into a new trade system, gold likely keeps a sturdy bid as long as official buying stays strong and geopolitics remain delicate. Wall Street continues to lean into that logic, lifting price targets on the view that central banks remain net buyers while rates drift lower. If that thesis holds, the metal's baseline demand looks less like a narrative and more like a fundamental structural demand shift. For currency markets, we can expect more fragmentation at the margins, but not a complete overhaul of the status quo. More trades will clear in local money. More banks will route through alternative systems. But the deep pools of dollar liquidity, foreign exchange, funding, and treasuries still anchor global finance. So, shifts will feel incremental until the new systems carry serious volume for a long time. That means we need to keep an eye on the volumes these new rails are seeing, any developments around convertibility or gold collateral, and whether central banks keep reporting bigger bullion piles. Those are the signals that can tell us if we're truly looking at the start of a slow rewiring that quietly leads to a world that no longer revolves around the dollar. Now, the story may sound compelling, and depending on your news source, it may seem like things are already in motion towards this new paradigm, and that momentum cannot be undone. But how realistic is it that a BRICS union manages to escape from dollar dominance? Well, here's where things get hard for BRICS' ambition. It's one thing to build new rails, it's quite another to get a load of countries with very different politics and payment headaches to use them the same way. The misalignments are as clear as day. They can be seen in membership questions, border friction, sanctions risk, and simple convertibility rules that make things all the more complicated. First, the actual makeup of the BRICS group is not yet settled. For example, Saudi Arabia is one swing player for oil trades and, well, it still appears to be hedging. Showing up to BRICS meetings, deepening China ties, but stopping short of a clean declaration that they're willing to join the bloc. That's some strategic ambiguity from a country that prizes its relationship with the US and US market access. If Riyadh won't lock itself in, any new system that needs the energy giant's full weight will advance more slowly. Then there's the Argentina example from 2023. They were invited to join the BRICS, then they were out. That's a reminder of the obvious here, that we're dealing with politics and individual representatives. It also exposes a bigger point. BRICS isn't a treaty bloc with binding rules. It's a coalition that can expand and contract with elections and priorities. Don't expect automatic alignment on money and settlement when the membership list itself can change in any given year. Then, to be frank, there's an underlying element of mistrust and bad blood. India and China are generally on good terms now, but the scar tissue from their recent Himalayan border clashes hasn't gone away. When two of the biggest players in the group carry lingering security friction, shared payment infrastructure will move with caution. You can pursue a practical agenda and still keep one foot hovering over the brake. New Delhi has been doing exactly that. Payment mechanics also bring their own type of drama. Sanctions risk has previously resulted in jammed deals, with banks in China, Turkey, and the UAE dragging their feet on Russia-related transfers. If compliance teams think a transaction could trip secondary sanctions, then payments stall, and commerce hates uncertainty. New rails help, of course, but compliance culture doesn't change that swiftly. Even when everyone wants to trade, currency logic and maths can still run into issues. Depending on how geopolitics develops during any particular stretch, any given BRICS country can find themselves sitting on a sizable amount of currency that isn't widely usable. That means someone can get stuck holding the bag, and gold won't necessarily alleviate these issues either. Then there are macro regimes that don't line up. China still runs with a partially closed capital account by design, which limits how far and how fast the renminbi can serve as a fully usable settlement and savings currency for everyone else. India, for its part, keeps a cautious stance on convertibility and has even tightened some outward remittance channels this year. Now, those choices aren't wrong per se, but they're policy realities that make a unified approach harder to execute. Energy trade adds further issues. When Washington tightened sanctions, the Russian oil trade had to reroute fast, freight costs spiked, and refiners in Asia scrambled. Shocks like that push countries to diversify away from dollars, but it also shows the fragility of alternatives when the pressure really rises. If a workaround depends on a handful of banks in a handful of places, one policy note can slow the whole chain. Now, none of this says the BRICS project stalls out. But it does say progress will be uneven, and it makes it less likely that any potential gold-backed system can be maintained. A new system might run smoothly for a while, but the dollar remains dominant enough such that any sign of stress is likely to push countries back to the greenback when risks flash. Layer on all the politics we covered and you get the full picture. Every BRICS capital has a different tolerance for blowback, a different inflation cycle, and a different view of how open its currency should be. Nobody is racing to surrender policy flexibility, even if they may want to stick it to Uncle Sam. The rails will expand. Gold will keep a role. But alignment across this many moving parts isn't a straight line, and it certainly won't behave like one. All right, that's our outlook on BRICS and their gold accumulation. A mixed bag of incentives and realities, but what do you think? Will BRICS countries keep pushing hard to ditch the dollar? Let us know your thoughts down in the comments. And if you could drop a like on this video, subscribe to the channel, and share it with anyone you think would enjoy content like this, it would be greatly appreciated. Thank you all for watching, and I'll see you again soon. This is Guy, over and out.